Let's have a sesh on working capital. So working capital is about your operating liquidity. And what your operating liquidity basically means is about your ability to pay short-term obligations or just short-term debts. The formula for working capital is current assets minus current liabilities. Current assets is short-term things that you own, and current liabilities is short-term things that you owe. If you really break down current assets, well, it's cash plus stock plus debtors. And if you break down current liabilities, it's basically creditors. So really the formula is, for working capital, cash plus stock plus debtors minus creditors. With working capital, you want to have a positive working capital. You want to have your current assets to be a greater number than your current liabilities. And if you in fact have it the other way around, that your current liabilities are greater than your current assets, well, that's negative working capital, and you don't want that. And that's known as working capital deficiency. Let's look at the formula again. So cash plus stock plus debtors minus creditors. Really, the game is with working capital is that you want to convert your stock into cash as soon as possible. You want to convert your debtors into cash as soon as possible, and you want to alleviate the amount of creditors you have, so therefore you hold more cash. Let's look at each of those three options. So stock, how do you turn stock into cash? And because if you hold more cash, you have better operating liquidity. Well, stock, you're trying to sell stock. That's the whole point of it. So the quicker you sell it, the more you have in terms of cash. The next thing is you don't want to overstock. Because if you hold too much stock, more than you're ever going to sell, well, then that means you're always going to have stock just sitting there, and you won't be able to convert it into cash quickly. So an idea there might be to destock, to hold less stock. A way that you could make a decision in order to hold less stock would be to do better market research, to actually go out there, do market research, whether it's primary or secondary, and work out how much stock you need to hold in order to hold the correct amount that you can convert it through sales into cash as quickly as possible. The other thing you could think about is just in time, being lean production, because that might enable you to hold the minimal amount of stock possible. The next thing you could look at is debtors. Debtors is being money that you are owed in the short term. Well, one thing you might want to do is reduce your debtors day, to reduce the amount of days that you are expecting to receive this cash. You might want to put stricter credit terms on, for example. Another option could be you could use debt factoring, meaning that you could sell those debtors to a private company and exchange receive a portion of that cash, usually 90% of it. The next thing is creditors, because with creditors, maybe you want to delay the pace at which you pay your suppliers. Because if you delay the pace that you pay your suppliers, well, that means you're holding more cash as a consequence. But you don't want to delay it too much, because you could ruin the relationship between you and your suppliers. And it's very likely that your suppliers are supplying you with the raw materials and components that are absolutely vital to your product. And if you manage to deal with situation 1, situation 2, and situation 3 effectively, then you have operational efficiency. And that's a great thing, because that means that you've reduced your working capital cycle, the conversion rate of all of these into cash. You've reduced that, and that's fantastic. And why that's fantastic is because it's going to mean that you convert it into cash quicker, therefore you're likely to hold more cash in the short term. And if you hold more cash in the short term, well, you've got operating liquidity. I hope that helps with working capital, and I'll see you at the next sesh.